Are you an investor struggling to make informed decisions about which stocks to buy? Do you find yourself overwhelmed by the complexity of evaluating a company's financial health? If you enjoy this video, please subscribe to my channel and press like button. Welcome to the world of stock fundamental analysis, your key to unlocking the secrets of successful investing. In this video, we'll guide you through the essential steps to evaluate a company's health and make smarter investment choices. At its core, fundamental analysis is about understanding the intrinsic value of a company. It's like taking a deep dive into the company's financial statements, management, competitive advantages, and industry position. By mastering these techniques, you'll be able to identify undervalued stocks and potentially lucrative investment opportunities. Let's start with the foundation of fundamental analysis: financial statements. These documents provide a wealth of information about a company's performance and financial health. The three main financial statements you'll want to focus on are the income statement, balance sheet, and cash flow statement. The income statement, also known as the profit and loss statement, gives you an overview of a company's revenues, expenses, and profitability over a specific period. It's like a report card that shows how well the company is performing in terms of generating sales and managing costs. Key items to look for in the income statement include: 1. Revenue. This is the total amount of money a company brings in from its core business activities. A consistently growing revenue is generally a positive sign, indicating that the company is expanding its market share or introducing successful new products. 2. Gross profit. This is the difference between revenue and the cost of goods sold. It shows how efficiently a company can produce and sell its products or services. 3. Operating income. This figure represents the profit generated from the company's core business operations, excluding interest and taxes. It's a good indicator of the company's ability to generate profits from its main activities. 4. Net income, also known as the bottom line. This is the final profit figure after all expenses, including taxes and interest, have been deducted. A consistently positive and growing net income is typically a good sign for investors. Now, let's move on to the balance sheet. This financial statement provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. It's like a financial photograph that shows what the company owns and owes. Key components of the balance sheet include: 1. Assets. These are resources owned by the company that have economic value. They can be tangible, like cash, inventory, and equipment, or intangible, like patents and trademarks. 2. Liabilities. These are the company's financial obligations, including debts, accounts payable, and future expenses. 3. Shareholders' equity. This represents the owner's stake in the company and is calculated by subtracting total liabilities from total assets. When analyzing the balance sheet, pay attention to: 1. Liquidity ratios. These measure the company's ability to meet its short-term obligations. The current ratio, current assets divided by current liabilities, is a common liquidity metric. 2. Debt-to-equity ratio. This shows how much debt the company is using to finance its operations relative to its equity. A lower ratio generally indicates a stronger financial position. 3. Working capital. This is the difference between current assets and current liabilities, representing the company's short-term financial health. The third crucial financial statement is the cash flow statement. This document shows how cash moves in and out of the company over a specific period. It's like tracking the company's bank account, giving you insights into its ability to generate and manage cash. The cash flow statement is divided into three sections. 1. Operating activities. This shows cash generated or used in the company's core business operations. 2. Investing activities. This section details cash flows related to the purchase or sale of long-term assets, such as property, plant, and equipment. 3. Financing activities. This includes cash flows from issuing or repaying debt, as well as dividend payments and stock transactions. When analyzing the cash flow statement, look for: 1. Positive operating cash flow. This indicates that the company is generating enough cash from its core business to fund its operations. 2. Free cash flow. This is the cash left over after accounting for capital expenditures. A consistently positive free cash flow is a good sign of financial health. 3. Cash flow trends. Look for consistent growth in cash flows over time, as this can indicate a strong and sustainable business model. Now that we've covered the basics of financial statements, let's dive into some key financial ratios that can help you evaluate a company's performance and compare it to its peers. 1. Price to earnings, PE, ratio. This ratio compares a company's stock price to its earnings per share. A lower PE ratio may indicate that a stock is undervalued, while a higher ratio might suggest it's overvalued. However, it's important to compare PE ratios within the same industry, as different sectors can have vastly different average PE ratios. 2. Return on equity, ROE. This measures how efficiently a company uses its shareholders' equity to generate profits. A higher ROE generally indicates better management performance and more efficient use of capital. 3. Debt-to-EBITDA ratio. This ratio compares a company's debt to its earnings before interest, taxes, depreciation, and amortization. It helps assess the company's ability to pay off its debts. A lower ratio is generally preferred, as it indicates less financial risk. 4. Price to book, PB, ratio. This compares a company's market value to its book value. A PB ratio below 1 might indicate an undervalued stock, but it's crucial to consider the reasons behind a low ratio, such as poor future prospects or financial distress. 5. Dividend yield. For income-focused investors, this ratio shows the annual dividend payment as a percentage of the stock price. A higher yield can be attractive, but be cautious of extremely high yields, as they may not be sustainable. While these financial metrics are crucial, fundamental analysis goes beyond just crunching numbers. It's equally important to assess qualitative factors that can impact a company's future performance. Let's explore some of these non-financial aspects. 1. Management quality. Evaluate the experience, track record, and integrity of the company's leadership team. Look for management that has a clear vision, a history of delivering on promises, and a strong alignment with shareholders' interests. 2. Competitive advantage. Assess the company's unique selling propositions and barriers to entry in its industry. Does the company have strong brand recognition, proprietary technology, or economies of scale that give it an edge over competitors? 3. Industry trends. Understand the broader industry landscape and how it might affect the company's future prospects. Is the industry growing, mature, or declining? How is technology disrupting the sector? 4. Regulatory environment. Consider any regulatory challenges or opportunities that could impact the company's operations. This is particularly important in heavily regulated industries like healthcare, finance, and energy. 5. Economic moat. This term, popularized by Warren Buffett, refers to a company's ability to maintain competitive advantages over time. Look for companies with wide economic moats that can protect their market position and profitability. 6. Corporate governance. Evaluate the company's governance practices, including board independence, executive compensation, and shareholder rights. Strong corporate governance can help protect investor interests and promote long-term value creation. 7. Environmental, social, and governance (ESG) factors. In today's investment landscape, considering a company's impact on the environment, its social responsibilities, and governance practices is increasingly important. Many investors believe that companies with strong ESG practices are better positioned for long-term success. As you delve deeper into fundamental analysis, it's crucial to understand that no single metric or factor should be viewed in isolation. Instead, aim to build a comprehensive picture of the company by considering multiple data points and qualitative factors. Here are some additional tips to enhance your fundamental analysis skills. 1. Compare with peers. Always evaluate a company's metrics in the context of its industry. What might be considered a good ratio in one sector could be subpar in another. 2. Look for trends. Don't just focus on a single year's data. Analyze trends over several years to get a better understanding of the company's trajectory. 3. Read beyond the numbers. Dive into the company's annual reports, earnings call transcripts, and management discussions. These can provide valuable insights into the company's strategy, challenges, and opportunities. 4. Consider macroeconomic factors. Understand how broader economic trends, such as interest rates, inflation, and GDP growth, might impact the company's performance. 5. Stay informed. Keep up with industry news, technological developments, and regulatory changes that could affect the company's future prospects. 6. Be skeptical, don't take financial statements at face value. Look for red flags, such as frequent restatements of earnings, unusual accounting practices, or discrepancies between reported earnings and cash flow. 7. Use multiple valuation methods. Different valuation techniques can yield different results. Consider using a combination of methods, such as discounted cash flow analysis, comparable company analysis, and precedent transactions, to arrive at a more robust valuation estimate. 8. Consider the company's growth prospects. Look beyond current financials and assess the company's potential for future growth. This might include analyzing its product pipeline, market expansion plans, or research and development initiatives. 9. Understand the company's business model. A deep understanding of how the company makes money can provide valuable insights into its sustainability and growth potential. 10. Be patient. Fundamental analysis is not about finding quick wins. It's a methodical approach that requires time and effort but can lead to more informed and potentially more profitable investment decisions in the long run. Remember, while fundamental analysis is a powerful tool, it's not infallible. Market sentiment, unforeseen events, and macroeconomic factors can all impact stock prices in ways that may not be immediately apparent from financial analysis alone. Therefore, it's wise to combine fundamental analysis with other investment strategies and always diversify your portfolio to manage risk. In conclusion, mastering stock fundamental analysis is a journey that requires dedication, continuous learning, and practice. By developing a systematic approach to evaluating companies, you'll be better equipped to make informed investment decisions and potentially achieve your financial goals. Now, it's time to take action. Start applying these fundamental analysis techniques to evaluate your next potential investment and unlock the path to more confident and successful investing.